Stephen, we're looking at U.S. inflation of about 7%, the highest in 40 years. How much does the Fed have to raise rates to rein in inflation at that level, given that it has promised to contain consumer prices?
Well, a lot of this is in the expectation. So don't forget the 10-year Treasury isn't referenced off of the spot inflation rate of 7%. So it's not like we're subtracting the 1.8 from the 7%. The question is, where will we be in the coming years? And it's reasonable to expect by the fourth quarter of this year that we've got a 2 handle, and on the wide, say between 2 and 3%. Now, that's not what some people were expecting last year. Most people were expecting inflation back at the target level. But clearly, many challenges have been thrown at this inflation question. Obviously, some things are completely out of anyone's control. So the question of lockdown in some parts of the world clearly is delaying that peak from rolling over. So it's difficult to forecast inflation. I think most U.S. economists are fairly beaten up on this one. No one was forecasting 5, 6, and 7% at the back end of last year. So now we're facing the delay to the peak, but it does seem fairly inevitable that it will be cooling off and heading back towards target, but maybe not as fast as we had thought before.
Not as fast and towards target. What exactly is that? Where will inflation normalize? And given that level that you're expecting, where should rates be?
Well, it's going to be path dependent, if you like. It depends on the data. Once the Fed starts hiking, I guess they will make it data dependent. And that means that when you get to, say, June or July in the summer, and inflation is falling and maybe unemployment is going up, and perhaps there are some financial stability considerations around the world, maybe the Fed isn't so obviously going to hike at every single meeting. Because the way the market has traded, the way the forwards have moved, it's as if to say the Fed's going to hike at every single meeting this year and into next year. And of course, some people are forecasting that. I'm thinking, how could anyone possibly know? It has to be dependent on the context at the time. So let's wait and see until the summer. The Fed will have communicated on the path of rates and on the balance sheet. And as we can see, there's a lot going on, and the feedback loops coming in from the riskier parts of the asset markets. That's quite interesting, because what does the Fed do faced with falling stock markets, for example? Well, I guess we're going to find out.
Well, we will do. We are finding out. Steve, though, what do you say to those who say that the Federal Reserve is behind the curve?
Well, I guess they are, and they have been. The Fed had average inflation targeting, and no one's mentioned that for the best part of 3 or 4 months. It's as if they've walked away from it. So the Fed, in a way, painted itself into a corner with its employment objective and the average inflation targeting, and couldn't hike. Meanwhile, in the rest of the world, you've seen tightening starting in Asia, way ahead of what we saw in the US. In fact, parts of Eastern Europe as well. So more hawkish central banks, and I would say, led by Korea, for example, are way ahead of the Fed. So it is a fact, isn't it? They are behind other central banks, but their policy was not perhaps designed for the challenges of the pandemic. And the average inflation target was a considered attempt to address the disinflation of the previous decade. What the Fed didn't know was that would all be solved for them in the space of 1 year. So yes, they are behind other central banks. I think that's correct.
Okay, Steve, if the path of least resistance for the dollar is for it to get stronger, what does that mean for policy in this part of the world? What does it mean for inflation, crucially, given a stronger dollar will make commodities more expensive and therefore lift up asset prices in in countries in this part of the world. And of course, that would necessarily also mean perhaps that we might even see a little bit of a move downward in prices as they export against the background of the strength of the dollar itself.
Yeah, so here you're introducing the role of the dollar as an input into the decision on rates, when often it's actually an output. But it's a reasonable point. Let's reverse the causality here. If things continue and China is easing, the US is tightening, then it seems natural that the dollar would go up, all else equal. And at some point, that might start to tighten financial conditions from the perspective of the Fed. And this has happened before. Fed policy has been interrupted by developments in Greece only a few years ago, and because of Brexit, and because of China in the past. So I think a lot of the forecasting that's taking place for the US bond market seems to be based on a Wall Street type of view that isn't even looking out of the window. I think it is important to incorporate the external position as well. And so by incorporating the dollar in the thought process, I think you're quite right. How obvious is it that the Fed would continue hiking through the summer if China was easing? Let's just get to that point and see what's going on at the time. It seems to me that it's dangerous to assume nothing would happen.
Stephen, it's been so tumultuous. I mean, you got to find shelter somewhere. Will Chinese bonds be it? Can you find shelter there? Will they continue to outperform?
Chinese bonds, well let's stick with the government bonds here, because obviously the Chinese property bonds are a different story. But the Chinese government bonds have been a winner for the best part of the last year and a half. From a foreign investor point of view, if you'd owned Chinese government bonds, you would have done very well on a local currency basis, because don't forget, the Chinese currency has held up well, and then the bond yield has been slowly falling at a time when you've had a surge in US yields. So from a dollar-based investor perspective, owning Chinese bonds has been a winner for the best part of the last 18 months. And I think investors like to back winners. So that trend looks to continue for us, and we have quite consistently favoured Chinese bonds, and frankly, the easing that came through has been a long time coming. It's been telegraphed. I think it was in our view likely to come through for some time, but it's a slow pace. But the direction of travel is in favour of the investors.